Greetings, investors. Today, we're diving deep into a pivotal update on Manulife US REIT, a topic that has stirred quite a storm in the investment community. As the Dividend Uncle, I'm here to guide you through the complexities of Manulife US REIT's recent recapitalization package, a move prompted by negotiations with lenders following a breach in financial covenants. The market's response has been intense, with a sharp 40% drop in a single day. In this episode, we'll unravel the intricacies of the recapitalization, address investor concerns, and explore the potential path to recovery. Buckle up, it's going to be a ride. The market turmoil. Manulife US REIT finds itself at a crossroads, with the recent recapitalization package triggering a significant market downturn. The current price, plummeting to levels reminiscent of existential doubts, when we are not even sure whether there are any solution for the REIT will survive past the default, paints a challenging picture. But amidst the chaos, there's a potential solution for the REIT to emerge from this crisis. I provided details of the recapitalization package in my earlier video, the link is at the top corner. However, some investors are contemplating an alternative route, voting against the recapitalization package in favor of a liquidation. Let's dissect the key concerns raised by investors and understand the realities. Concerns over recapitalization. While there are several concerns over the recapitalization package, I'm going to focus on the top two concerns of investors. 1. Sponsor's loan interest rate. Investors are grappling with the sponsor's loan carrying an interest rate with effective interest rate of about 10% per annum. However, we need to recognize the constraints at play. Existing lender dynamics. As the REIT is effectively in default, existing lenders wield considerable influence in determining the recapitalization terms. Their primary goal is to reduce their loan exposures to the REIT, prompting the need for alternative lenders to step in. Financing market realities. The frozen state of the financing market for U.S. commercial properties left the REIT with limited options. The REIT explored loans with other lenders, but no one is willing to lend. The REIT having breached financial covenants doesn't help. The sponsor's intervention becomes a necessity in a market where willing lenders are scarce. Regulatory and shareholder constraints. Manulife, as a U.S.-listed large insurer, is subject to regulatory controls. Regulatory authorities are unlikely to permit preferential lending rates that could undermine the insurer's balance sheet. Shareholders of Manulife, considering the REIT as a very small portion of the overall business, are unlikely to approve such terms. They have little to lose even if the REIT goes down. IFA's evaluation. The Independent Financial Advisor, or IFA, report deems the maximum effective average interest rate of 10% reasonable, considering market conditions and prevailing rates of existing instruments. Mitigating impact. The impact on the REIT's overall interest rate is not as severe as perceived, with average interest rate increasing from current 4.38% to 4.4%. The manager plans to use proceeds from divesting Park Place and the sponsor's loan to retire variable debt averaging about 7%. In addition, the sponsor now has more skin in the game, which will align better with the REIT. 2. Dividend halt for 2 years. Another sticking point is the 2-year hiatus in dividend payments until December 2025. Here's the rationale. Lender priorities. Lenders, holding the reins on waiving covenant breaches, prioritize reducing exposure and ensuring the REIT's survival. Diverting dividends towards strengthening the REIT's financial position aligns with the lender's objectives, and I think is rather common practice for the lenders. Short-term pain, long-term gain. Acknowledging short-term pain for dividend investors, the hiatus is seen as a strategic move for long-term sustainability. The halt allows resources to be directed toward crucial objectives, potentially ensuring the REIT's survival. Mitigating impact. The management has assessed that the tax leakage during the dividend hiatus will be small, providing assurance amidst the short-term sacrifice. Liquidation realities. Rejecting the recapitalization in favor of a liquidation might not be a panacea. The liquidation process is inherently messy and hence uncertain, with equity holders positioned as the last to be paid. The U.S. office market's frozen state and the impact of forced sales could lead to significantly depressed sale prices, potentially resulting in minimal returns for investors. Most of the 12 lenders are local banks, and not as familiar with the U.S. property market. Hence, they are likely to want to dispose the properties quickly, exacerbating depressed sale prices. Net asset value will be doubly affected by lower valuations. Let me illustrate. As at June 30, 2023, asset value is at $1,821 million, and loans at $1,081 million. This resulted in net assets of $741 million, and a net asset value per unit of 40 US cents since there are 1,835 million shares. Now, if sale price is depressed as vulture-type buyers dive in for a kill, assume properties are sold at 35% discount to the valuation, the asset value drops to $1.184 million while the loans remain the same. The net asset drops to $103 million, with net asset value per unit at a mere $0.056. Moreover, 35% discount may be an underestimate. The head of Whalen Global Advisors said in Financial Times that if banks repossess the building, the drop could be 50%. The Dividend Uncle's take. I've had conversations with fellow investors, and I understand the apprehensions. As one viewer of my channel noted, retail investors are caught between a rock and a hard place. Yet, when faced with the alternative of a messy liquidation, the recapitalization package emerges as a potentially better option. Skeptics may ask, could the terms of the sponsor loan be more favorable? Are we allowing the sponsor to rip us off with 10% interest rate? Maybe yes, but I wouldn't call an increment of 3% points over variable interest rate of existing loans of 7% a rip-off. It is definitely on the high side. But let's not discard the opportunity for recovery just because the solution is not ideal. Remember, in the world of investments, the perfect solution is a rare guest. At the upcoming EGM, I'll be voting yes to the recapitalization, advocating for the REIT's chance at recovery. A united front among lenders, increased skin in the game for the sponsor, and the potential rebound of the U.S. commercial market as the REIT explores sale of its non-strategic assets, create a pathway for a brighter future. Finally, I would like to leave you with parallels to past cases like Eagle Hospitality REIT, where unit holders rejected proposals to allow the REIT to continue operations, and it led to zero returns for all its unit holders. Conclusion. As we stand at this crucial juncture, investors in Manulife US REIT should grasp the severity of the situation. The REIT is effectively in default, and a consensus among all 12 lenders, coupled with sponsor support, is a challenging feat. While the recapitalization may not be the ideal scenario, it stands as a potential lifeline. Let's keep a pragmatic outlook, understanding the constraints and aiming for the long-term recovery of our investments. Until next time, stay informed, stay prudent, and happy investing.